So we have a very interesting topic now. It's on democratization of high yield debt products in India. You know, the Indian investor is a yield seeker. Indian investor loves a nice deal. And we have Ms. Satya Sontanam moderating a panel on this particular topic here today. It's my pleasure to introduce Ms. Satya Sontanam. She's a chartered accountant by qualification, and she's developed a keen interest in personal finance. She worked as a research analyst with the Hindu business line at Chennai, tracking metal sector and personal finance. She is very curious about the stories behind the trends and the numbers. Very interesting. Understanding the narrative is very critical for investing. And she has worked a lot towards presenting complex subjects in a much simplified manner. She's currently a senior content editor with Hindustan Times Mint. Over to you, Ms. Satya.
Can you hear me? Hi. Can you all hear me? Hello?
Yes, ma'am, you're audible.
Yes, okay. Hi, thank you all for joining in. A very good evening. Welcome to CFA Society India's third India Fixed Income Summit 2021. My name is Satya Sontanam and I am Senior Content Creator at Mint's Personal Finance team, and I'll be moderating the session. The theme of this session is democratization of high yield debt products in India. In this low interest rate environment, traditional fixed income products like fixed deposits have seen its interest rates falling sharply. And with the threat of inflation, there is a risk of negative real interest rate as well. At this juncture, few of the products like as an opportunity to increase awareness of these products so that investors can take informed decision. I can't wait to start this session. I have a lot of questions. I hope you all do have a list. So without any further ado, let me introduce the brilliant guests on our session today who will be speaking to us on various high yield debt products in India and what should investors consider before investing in these products. So let me introduce the guests in alphabetical order of their names. First, we have Mr. Anshul Gupta. Anshul is co-founder and CIO of Wint. Backed by Zerodha's Rhine Matter Fund, Wint is looking to democratize the debt markets in India. Anshul did his BTech from IIT Roorkee and was previously the head product development at Northern Arc Capital. Welcome, Anshul.
Thanks, Satya. Pleasure being here.
Yeah. Next, I would like to invite Mr. Nikhil Agarwal. Nikhil, are you here? I can't see you. Is Nikhil here? A team, can you just tell me if Nikhil is here? The crew team, please.
So Nikhil will join in a while. You can continue.
Sure. We can continue then. Let me introduce Nikhil anyways. Nikhil Agarwal, who is the founder and CEO of Grip Invest with a degree in economics and an MBA in finance. Nikhil started his career at HSBC and subsequently spent 6 years as part of the investment banking team at Morgan Stanley. Our last guest, but not the least, is Vibhor Mittal, who is the Chief Products Officer at CredAvenue. Vibhor has over 15 years of experience in structured finance. In his previous role, he was the group head, structured finance rating at ICRA Limited. Vibhor holds a bachelor's degree in electronics and communications from Delhi College of Engineering and a master's degree in management from IIT Bombay. Welcome, Vibhor.
Yeah, thanks, Satya. And a big thanks to CFA Society India as well for having me here as a speaker.
Now over to you. I don't have anything to say. I would love to hear from you all on what are the, in your words, what are the products, high yield products that you are providing on your platforms, and what problems in the debt capital markets are you trying to solve? Mr. Vibhor, you have more than a decade experience in this industry. Maybe we can start with you.
Yeah, thanks. So let me just quickly tell you a little bit about CredAvenue, which is a company that I represent, right? So we are one of its kind debt platform company or a marketplace which connects borrowers who have funding requirements with various lenders and investors. We aspire to be the operating system for all debt transactions that happen in the country. We have 5 distinct platforms under the overall CredAvenue umbrella brand. So we have a loan platform, we have a bond platform, then we have an ABS platform for securitization transactions, supply chain and co-lending platform. On the client side, we deal with 1,000 plus entities and varying from ratings of borderline investment grade or maybe in BB category or sometimes unrated as well, all the way to AAA. We sector agnostic, cater to all fixed income products. And on the investor side, we have around 250 institutional investors and 3,000 retail investors. Now, having said that, some of the problems that we are trying to address, because of which, this entity was started, was that we want to deepen the debt markets in the country today and provide access of credit to a wide, array of issuers or borrowers who are otherwise not able to tap into bond market. So these would be entities which are rated in A category or lower, as we know that 90% or more than 85% of the bond issuances that happen in the country are for issuers which are rated in AA category and above, with a significant portion anyway being cornered by AAA and quasi-sovereign kind of entities. So there is a need to provide more access of funds to these set of entities. In terms of products, in terms of some of the problem areas that our platform today tries to solve for. So one is information asymmetry. So a lot of these clients would not be listed, and therefore a lot of information would not be available in the public domain. So our platform tries to bridge this gap by providing a lot of information on these entities and the portfolio of these entities, which then the investors can evaluate for making a great decision. Some of the other issues that plague the investment is essentially how to discover the right credit, how to price it right. So you need to have benchmarking tools, you need to have a lot of analytical tools, which you give in the hands of the investor for them to make a decision. There is also a lack of depth in the secondary market. So we don't see too much of trading happening, especially in these lower rated credit space. Some of these bonds where the yields could be low teens to mid teens to high teens. So there is a need for a platform which can facilitate an exit, act as a market maker for some of these transactions to happen. And as long as at least the underlying credit is holding, the investor should be able to get an exit when they have a need for liquidity. So, and obviously, to go with that, on the execution side, a lot of support, handholding is required for the investors. So these are some of the problem areas that we see investors facing in the market today, and this is something that our platform tries to solve for. I think you also asked on some of the products that we offer on the platform. So we are pretty much there across the entire fixed income space. We only focus on fixed income. We don't do equity, real estate, other exotic asset classes. But within the fixed income space, we pretty much look at all kind of products, including NCDs, market-linked debentures, sub-debt, PERPs, CP, CD. Even, we've seen REIT, InvITs, units, etc., being traded on our platform in the secondary market. So pretty much across the entire fixed income space.
Yeah, you have so many products, and we also have so many questions for you. You talked about ratings, liquidity, and pricing. So we have so many questions with respect to that. But before that, let me go to Mr. Anshul. Anshul, why don't you tell us about the products that are being offered on your platform, and what are your platform trying to solve in this debt market?
Sure. Thanks, Satya. So Wint, essentially it's a fixed income focused debt platform. So if you look at the wealth industry in India, individual investors have had access to low risk, low return, traditional fixed income options like fixed deposits or debt mutual funds, where returns have been between, let's say, 5 to 6%. I mean, they're not even beating inflation. Gone are the Guram Rajan days, wherein RBI was providing 2% real interest rates to the savers. Presently, the real interest rates are zero or even in negative territory. So that's one option which retail investors have. The second option is on the other end of the spectrum, which is equity, where the risk return profile is between, let's say, 12 to 18%. So there is a huge vacuum in between these two extreme investment choices, which is what we are trying to fill at Wint Wealth. So essentially, the products that we have, they offer fixed income returns between 9 to 11%. And the good thing is these products are available at ticket size as small as 10,000, so that investors can start small, understand the product, and as they get comfort, they can allocate a larger portion of their portfolio in these instruments. Though Vijay mentioned Indian savers are yield chasers, our philosophy is Indians, they are greedy, but there is greed in moderation. So they don't want fixed income options where the returns are like very high and risks are very high. Rather, they want a product which can help them beat inflation by, let's say, 200 to 400 basis point. And that's the segment that we are targeting.
Cool. Great. Now, since Nikhil is not here, maybe we can go into the questions that I have for you. Thanks for the brief intro. And I have a couple of questions. I divided them into two segments. One, to understand where these products stand as of now. The second segment will be from the investor's point of view, what they are thinking and how will it benefit them. So my first question in the first segment is about these assets becoming part of the mainstream platform, mainstream debt products among retail investors in future. So yeah, anybody can take this question. So for now, these products are not in the mainstream debt platform, opportunities available to the investors. In future, how is it going to be? Anybody can take this question.
Sure. So I mean, you're correct in saying that, let's say, some of the products like bonds, etc., they haven't been democratized yet. So even though in India, I have access to much riskier options like equities of companies, private companies, and even riskier options like futures and options. But bonds, which are like much lower in risk category, retail investors haven't yet fully explored this investment option. And I think it's only a matter of time.
Why do you think so? Sorry to interrupt you, but why do you think so?
So I think 2-3 things. One is the access has been an issue, that since these bonds are not actively traded on exchange, they did not have access to a lot of these products. And secondly, I think Meera mentioned that equity is something which is much more fascinating. No one wants to understand what are covenants, what's duration, etc. So education with respect to fixed income market has been missing. So till we crack both these problem statements, which is of access and alongside education, I don't think the market will get democratized, and which is essentially what we are trying to solve at Wint Wealth by focusing a lot on education, transparency, knowledge, etc. And in parallel providing access to these instruments to retail investors at ticket size as small as 10,000 rupees. Okay.
Mr. Vibhor, what do you think? I mean, why are these products not in the mainstream platform as of now? And what do you see for these products in the future?
Sure. So see, I think Anshul covered some of the points. What I would like to add to that is that, for the market to really explode and want to see a wider participation from retail investors, there is a need for disintermediation to happen. which means giving direct access to these retail investors to invest in credits which are investable, right? And help them in making that decisioning. Now, what has happened is that there has been a lot of mis-selling also that has happened in this market. So we've seen instances where perps have been sold as with the communication that the risk is equivalent to a fixed deposit, right? Now that destroys credibility and it erodes confidence. Any investor, the psyche is that they're willing to take some risk when it comes to equity investments, where there is obviously a capital appreciation upside as well. But when it comes to debt products, the primary concern is how do I get my money back? So return of capital obviously is more important than return on capital, right? So, our view is that over a period of time, what you would see is that there would be good amount of disintermediation that would happen in this industry. The way it happened in equity markets in early 90s, and that is when the market will explode. So that is one. The other thing is, the potential of the market and the retail segment cannot be disputed. So I'll just give you a few numbers to put things into perspective, right? If we look at the inflows that are coming into mutual fund industry, and a lot of these funds obviously are coming in the equity segment and not so much in the debt schemes, but the monthly inflows today is around 10,000 crores a month. If I look at the overall AUM of the mutual fund industry, it's 37 lakh crores, and almost 45% of that is coming from retail investors. Today, we have more than 9 crore folios which have been generated, more than 7 crore demat accounts that have been opened in the country, right? And if you look at the fixed deposits which are outstanding with banks, the quantum is staggering. So even if one, thinks that 5 or 10% of those flows can come into, some of these fixed income products, obviously, there is a need for the investor to diversify his portfolio. And, at least we are of the view that, for any investor, depending on his risk appetite, investment horizon, certain proportion of its portfolio should always be allocated towards fixed income products, as opposed to just, being allocated entirely towards equity, where there is more volatility in terms of cash flows, returns, etc. And even that 5-10% will, make it a very, very large quantum in terms of the market potential. So, with right investor education and giving access, and, more importantly, getting that credibility, trust, not mis-selling the product, pricing it right, all that is important for the market to go.
You mentioned a very interesting point, which is mis-selling. Because of that, even if we see some instruments which are offering high interest rates, the first thing that comes to our mind is it a genuine product? So I hope this session also helps investors get aware of the various products that are available in the market. Vibhor, it is safe to say that issuances of market-linked debentures have seen a significant rise in the last 2 to 3 years. Your platform also facilitated issuances of MLDs in a significant way. So from your experience, tell us, have they become more investor-friendly?
So see, the biggest advantage of looking at a market-linked debenture is that these are more tax efficient, right? So as long as the instrument is listed and the holding period is more than 12 months, there's an opportunity for an investor to book the returns as long-term capital gains, as opposed to interest accrual, which would happen in a typical bond instrument. And therefore, the tax applicable on a more than 12-month investment period would be then 10% plus surcharge plus cess, which would work out to be 14% on, or just shy of 14% on an average. As opposed to that, for an individual who's in the highest tax bracket, including the surcharge and the cess, the taxation could work out to be as high as 43%. So there is a significant sort of a post-tax yield kicker, which is available to an investor if they were to invest in such an instrument, as opposed to a regular bond. Now, obviously, one needs to be mindful that these instruments are principal protected. So because, some of the instruments could also be non-protected, where even the principal could be at risk. And as long as that is not the case, and they hold the instrument, then for more than 12 months, and they're booking the gains as capital gains, then the post-tax yield could be substantially better. So that's the reason why we've seen this product pick up significantly in the retail market. A lot of interest coming in from HNIs, family offices, even some of the corporate treasuries who are using such instruments to make higher tax post-tax returns.
Okay, since you mentioned about taxation, what I understood about this MLDs, I could be wrong, please correct me if I'm wrong. So what I understood is only if the instruments are sold before its maturity, only then the tax benefits will come into picture. Otherwise, it will be charged to the investor's slab rate as income from other sources, just like other interest income. So what do you have to say about it?
Yeah, that is correct. So the investor would need to liquidate the instrument prior to the record date, which may be a few days prior to the maturity date. But finding an alternate investor for a short residual tenor should not be an issue. So to that extent, once that exit is facilitated, the post-tax returns for the investor could be much higher because of the tax efficiency that this instrument brings. The only other alternative for the investors to save on tax is obviously to invest in tax-free bonds. But of late, obviously, government has not been facilitating issuances of such bonds. And while some of these bonds may be available in the secondary market, but the yields are quite low. Could be as low as 4.5% in that kind of a range. So MLD is an attractive option from a taxation perspective for the investors.
Sure, thanks Vibhor for that. Anshul, your platform has made available several high yield investment opportunities which have been subscribed within a day of them opening it. First, does that surprise you? And can you elaborate on the types of instruments that are available on your platform?
Sure. So frankly, demand doesn't surprise me that much. I think Vibhor gave some numbers. If you look at the amount of money lying in savings accounts and fixed deposits, it's more than $1 trillion. And that money is earning zero real interest rates or negative real interest rates. So a lot of capital is chasing investment options wherein at least the real returns is in positive territory. And like I said, traditionally, investors have had only two extreme investment options, FDs and equities. There is a large vacuum out there, which has to be filled by the market. And Wint Wealth in some ways is filling that vacuum, and capital is ultimately getting deployed in those options. In terms of the products that we are offering, so we offer bonds, can be plain vanilla senior secured bonds, or even structured bonds as products to our investors. We do not list any unsecured bonds or subordinate bonds or perpetual bonds on the platform. We think these are too risky for retail investors. So the main product which is offered is a senior secured bond issued by entities in A rating category, AA rating category, and so on.
Okay, Anshul, I also remember, seeing covered bonds on your platform. But I think after RBI's recent guidelines on, securitization and asset transfer guidelines, the way things used to work have changed. So in what form is it coming back now? And what is that RBI circular or guideline about? Can you throw some light on that?
Sure. So RBI a couple of months back released a revised set of guidelines for securitization market. And one of the clauses in the guidelines was with respect to the assignment of underlying loans by NBFCs to third parties. And in covered bonds, this assignment of underlying loans was a key feature to make the underlying security bankruptcy remote. So even though guidelines were not meant for covered bonds, since there were some risks.
I'm so sorry to interrupt you, but for the benefit of listeners, can you explain briefly what a covered bond is?
Sure. So I think we all know how a senior secured bond works. there is an issuer which issues a liability, a bond, and provides some kind of security, collateral as an extra cushion. Now, the bonds work well, but a key issue is the underlying security is not bankruptcy remote, which means in a scenario that issuer were to go bankrupt, the lenders have to stand in the bankruptcy queue to make a claim on the underlying security. The main advantage of a covered bond is the underlying security, collateral, is made bankruptcy remote. And how it is done is by assigning or selling that security to a trust. And covered bond investors are the main beneficiaries of that trust. So that tomorrow, even if the issuer defaults, goes bankrupt, since the assets are not owned by the issuer, it's owned by a third party, the trust, investors can simply make a claim on that trust property, take their security and go home. So that was the main benefit of covered bond, that the underlying security was becoming bankruptcy remote by assignment of the collateral to a third party. Now, as part of the securitization guidelines, there were some regulations around any kind of assignment which NBFC can do. And the regulations restricted assignment to entities which are not RBI regulated. And trust is not neither a NBFC nor a financial institution. Hence, assignment to trust can no longer be done under the revised RBI guidelines. So a lot of discussion is happening in the market. People are speaking with regulators, law firms, etc., to find alternate covered bond structures. But the market view is, as things stand, the covered bond structures in their earlier avatar may not be feasible. But a lot of brainstorming is happening, and let's see if an alternate covered bond structure can come up.
Okay, what is the one key takeaway for an investor from this?
With respect to covered bonds?
Yes, and also the guideline. So what is RBI trying to, how is RBI trying to protect investor here? Because the main selling point of covered bond is high return as well as dual recourse. So what is the RBI trying to do here, and how will it be helpful to an investor?
Sure. So it's one can't say for sure that RBI willingly regulated covered bonds or put an end to covered bonds, because the regulations were meant for something else. They were meant for assignments and securitization transactions. It so happens that assignment was also a feature of covered bond product. So I think one can't draw inference that the regulations that came out were meant for promoting or restricting covered bonds. It might be purely incidental also.
Okay.
And that's why like a lot of market participants are reaching out to the regulator to seek clarity, like whether they want to promote covered bonds, or in their view, they will come up with a separate set of guidelines to regulate covered bonds, or maybe like even restrict them.
Okay.
So Satya, if I just may add to what Anshul has already said, right? So we from our platform, we facilitated almost 2,500 crore worth of covered bond transactions. We had almost a 50% share of this particular product before the guidelines came, right? So we do know a little bit about this product. Now, like Anshul said, it doesn't appear that it is an intended consequence, right? So the guidelines were for a different product, which is transfer of loans, which is a direct assignment market. It seems that inadvertently this has had an adverse impact on the covered bond transactions. That too, very important to highlight, not on the existing transactions. So on the existing transactions, obviously lawyers have opined that investor position is safe. It's only had an impact on incremental transactions. I think the way the covered bond transactions would evolve going forward is that there would be some specific covered bond legislation that would be put out by RBI. If I recall correctly, in 2012, NHB had put out some draft guidelines on covered bond transactions for housing finance companies. At that point of time, obviously NHB used to be the regulator for HFCs. Now that has been obviously brought under RBI itself. But unfortunately, those guidelines remained at a draft stage. So they did invite comments from market participants, but they never, converted them to final guidelines. Now, I think a specific, sort of a regulatory framework is something which the regulator would probably look at putting out. That's the expectation that the market has. And once that those set of guidelines are in place, which governs how these transactions should be structured, I think this product will then again pick up, and we'll see a lot of scale as well. Something which did not happen last time because there was no regulatory framework in place. But till the time that happens, this product obviously has gone into a limbo, and people are trying to figure out, but incrementally transactions have come to a halt.
Sure. Now my next question is about physical asset financing. I just want either of you to talk about what physical asset financing is, so that investor get an idea of what exactly it is, and whether they can go for it or not. So either of you, because this is also considered as one of the high yield debt products in the market. So can either of you elaborate on what it is for the benefit of listeners?
Sure. I think of late we are seeing a lot of structures come up wherein the investors end up financing a physical asset, can be computer equipment, furniture, or even real estate in some cases. Those assets in turn are deployed, and the returns which come from these assets are distributed amongst the investors. So that's broadly how this sector is operating. The entity can be a company, LLP, trust, etc. So a lot of new structures, innovative structures are being tried to promote asset financing. This is also an alternate, I'll say, fixed income instrument, which is emerging.
Right. Thank you, gentlemen. With that, my first segment of questions have come to an end. My second segment is from investors' point of view, as I mentioned. So in that, my first question is, Vibhor, you already mentioned that when it comes to investing and returns, investors don't mind taking risk in equities, but when it comes to debt, the first thing they would want to know is my capital safe? So how important is this to take into account the credit rating of the borrower? What kind of investors are these high yield debt products suitable for? Anybody can take this answer.
Sure. So see, credit rating obviously is an important parameter for an investor to look at when they are making credit decisions, but it is not the only parameter, right? And obviously, you have some rating agencies which are slightly more credible than others, right? So that has to be kept in mind. When it comes to high yield segment, which would be largely, instruments which are rated in BBB category or thereabouts, at least we use one of the two guiding principles. So either we believe that the entity should have a demonstrated track record of generating profits, right? So we would be comfortable then picking up those entities. Alternatively, the entity should be backed by strong PE investors, and they should have a strong corporate governance in place. So, we would only put those papers or offer those papers to the investors where at least one of these two criteria are being met. So that's, there can obviously be one or two exceptions to this rule, but that's the broad yardstick that we go by when we, bring these credits to the market. Not all lendable entities are investable. Now, what I mean by that is that as a lender to the company, when I'm talking through the loan market, where I'm a bank or I'm an NBFC which is funding to these entities, I can lend to a lot of entities, obviously, depending on my risk appetite, credit cost that I'm budgeting, I can price that risk. I can give loans to a lot of these entities. But not all entities are ready for being brought to capital market investors. The reason for that is there needs to be better financial discipline, strong reporting, MIS compliance, MIS systems in place. Covenants have to be tight, and if there's a breach of covenant, then there are repercussions. If the paper is being distributed to retail investors, then it could be distributed in a fragmented manner, and getting any deviation on the covenants could also become difficult. So therefore, while a lot of entities probably can be considered from a lending exposure point of view, but when it comes to issuing bonds and taking these entities to capital market investors, one would need to have a more stringent selection criteria in place.
Okay. Is it safe to say that as a facilitator of issuances of these bonds, or that you are doing a first step of due diligence? Can we say that?
Yeah, that we do for a large set of entities, especially for papers, that we facilitate through the platform in the course of primary issuances. So there are also, papers which are listed, which are available for secondary trades, where any seller can come on our platform, and if he wants to liquidate his portfolio, he can put that those instruments on the platform, and investors can take those instruments. But at least papers that we are manufacturing and the papers that come from CredAvenue stable, we kind of ensure that we are doing a detailed level of due diligence in terms of taking a credit view, and also basic hygiene checks that which involves ensuring that the strong counterparties in place, documentation is proper, and so on. So that's something that we look at very, very closely.
Sure, thanks. Mr. Anshul, your take on this?
Yeah, no, I kind of agree with Vibhor. Like, one cannot only rely on rating agencies to make an investment call. In the past, we have seen even AAA rated entities default on their liabilities. One more point which I want to add here is it's very interesting to note that rating agencies in India are rating probability of default and not loss given default. So that's why, let's say there is a entity which is rated as A by a rating agency. Whether the issuer issues a senior secured bond or a senior unsecured bond or a subordinate bond, all three bonds get same rating, which is A. And that's kind of, I'll say, a flaw in the system, which should be corrected, because a retail investor, if they see a subordinate bond rated as A, they might equate it with a senior secured bond, which again has the same rating. So that is one big problem in the rating agencies, with the rating agency models, that they're rating probability of default and not loss given default. And that's also a root of a lot of mis-selling which happens in the market. A lot of A-rated subordinate bonds, perpetual bonds might be mis-sold in the market. So that's why, like, in addition to looking at the rating of the instrument, it's very important for the investor to do his or her own diligence, understand the issuer, understand the structure, and only once there is comfort on the underlying paper, one should proceed with the investment.
Yeah. It's a very interesting point made on the rating. Thanks for that. And the next question is about liquidity. So there's a concern of liquidity in this market if an investor wants to withdraw from scheme before maturity. So what do you have to say for that? Mr. Anshul?
Right. So I think it's kind of a chicken and egg problem in the debt markets. There are no investors because there is no liquidity, and there is no liquidity because there are no investors. So for the time being, we, at least on our platform, we tell investors not to park their emergency funds in these instruments, invest only that much capital which they are comfortable holding till maturity. Because even though there are like 10,000 plus investors on our platform, and whenever an investor wanted to sell his or her own security, we were able to find a willing buyer. But there might be extreme scenarios wherein such willing buyers may not be available. So for the time being, investors should only invest that much amount which they are comfortable holding till maturity. Over time, we do hope, however, that once there are enough investors in the this market, liquidity will follow. If there are like millions of investors investing in these securities, more and more willing buyers will start coming up. And hence, when that time comes, even the liquidity challenge will be solved.
Great. Hoping for that. Mr. Vibhor, I remember that during the beginning of the session, you were saying something about liquidity and it's decent enough. So why don't you say something about that?
See, liquidity is obviously an issue for investors, especially as one starts moving down the credit curve and looking at high yield papers, right? Now, our platform obviously solves for that to some extent. Our view is that as long as the underlying credit is holding, today we have a large set of investors who probably would buy. We would be able to find a willing buyer, like Anshul said, if the investor needs an exit. Having said that, there are a lot of measures that regulators have taken to address this, right? Number of ISINs have been restricted to ensure that, under each ISIN, we have a decent quantum of amount outstanding. So there is a vibrant secondary market. One sees that, over a period of time, there have been a lot of incentives that have been given to various investor segments to look at some of these investments, including offshore investors as well. So that is there. But yes, I mean, in times where the liquidity suddenly becomes tight, that remains a concern. I think the draft regulations, which again SEBI has put out, where they're saying, where they're talking about a market making, where they're saying that, there's something on which they were requested for comments, right? So it's not in the final stage, but they're saying that either the issuer or the arranger in any issue would need to give two-way quotes. And if I remember correctly, I think they say that to the extent of 25% of the issuance amount over a quarter. So it is incumbent upon the arranger or the issuer to get an entity which can do this market making activity for every issuance that happens. I think this is something that if it comes to light, I think can solve the liquidity issue to some extent. Now, obviously, the challenge is, where do you find such arrangers or market makers, and do they have enough pockets to or pools of capital to give such two-way quotes on not so liquid paper? So that's something that one will have to see. But at least one seems to be heading in the right direction.
Okay, to sum up for the investors from the first two questions, the two key takeaways are: first, it's not just just looking at the credit rating is not sufficient. One should also do their due diligence to understand the issuer better. So that's the first key takeaway. The second is, since the liquidity is an issue for now, investors should invest only that much amount which they're comfortable to hold until maturity. There could be a liquidity flow in future, but for now it is better to stick to only that part of investment which they can hold till maturity, right? Right? That's what I'm saying.
Right.
Yeah. Sure. My next question, again, the following up on the risk factor. These products are not directly regulated by any of the regulated bodies such as SEBI or RBI. What kind of grievance mechanism is available for investors on your platforms? So, Mr. Vibhor?
Yeah, so I think 90 to 95% of the papers which are listed on our platform, they're all listed instruments. So obviously they are regulated by SEBI. And to that extent, there are grievance redressal mechanisms which are in place. Even for unlisted instruments, there is a legal recourse, legal remedy that is available to the investors. So they can go through the debenture trustee route, for example, in case of an NCD instrument, and file a case in the court if they feel that they want to litigate against the issuer because they've either not got the payment or some of their rights have been infringed upon. The remedy to take legal action, be it under SURFACE or going to IBC, for example, in a case of a bankruptcy scenario. So those options are obviously available to investors to consider, even in case of an unlisted instrument. Yeah, Anshul, if you would like to add to that.
No, like Vibhor rightly mentioned, wherever the bonds are listed, they are definitely regulated by SEBI. And wherever the issuer is a NBFC or a RBI regulated entity, those bonds are also regulated by RBI. On our platform, we only list bonds issued by NBFCs, which in turn make them regulated by RBI. And all the bonds are listed on exchange also. So all the bonds are regulated by both RBI and SEBI. In parallel, there is a SEBI registered debenture trustee also. And if there is any grievance, etc., that the investors can reach via trustee to address their problems.
Sure. Coming to my next question, what are the top 3 factors you would want an investor to take note of before investing in these products? I understand we have discussed about so many investors related questions as of now, but what are the 3 main factors that you want investors to look at before investing in these instruments? Mr. Anshul?
Sure. So I think one thing is they should not put all their eggs in one basket. They should start small and diversify. Let's say their portfolio is worth 100 rupees. They should not park more than 5 to 10% of their portfolio in high yield instruments. And within that 5 to 10%, there should be adequate diversification across at least 5, if not more, products. So that tomorrow, if something were to happen to one exposure, it doesn't affect a large portion of their portfolio. Because
Sure.
Even though all the mitigants are there, the diligence, etc., is done, these instruments are not an alternate for FD. So these are not risk-free instruments. Second point, which they should notice, they should only invest once they understand the risk. And they should note that these are not alternate for FDs. These are not zero risk products. And lastly, I think the thing that I said earlier also, they should invest only that much amount that they're comfortable holding till maturity, because the market is still nascent. These are not very liquid products. In regular times, liquidity may be available, but in extreme scenarios and events like demonetization, COVID, etc., they may not be willing buyers in the market. So yeah, I think these are the 3 things which any investor should note before investing in these products.
Okay, Mr. Vibhor?
Yes, some of the things Anshul has already covered. So I'll just add to that list. So I think the investment horizon and the investment objective needs to be considered, right? So if an investor wants monthly cash flows, then he's better off investing in an instrument that is amortizing, where there is some amount of capital that is coming back along with the interest. Okay, but if he's happy investing and staying invested for a period of 3 years, 5 years, and so on, then obviously he can look at some of the other options like MLDs, bullet instruments, etc. If there is less volatility around cash flows that the investor is seeking, then obviously higher allocation has to be towards fixed income asset products as opposed to equity investments. So I think that becomes important. The second thing is obviously how much risk appetite the investor has. So if it's an investor, who has a small portfolio, he wants to be conservative, preserve capital at all costs, then he's better off not investing in high yielding instruments, which can be relatively more risky. But if it's a large HNI investor, who has a very, very diversified portfolio, then obviously for better yields, he can look at parking, like Anshul said, a portion of his portfolio in such instruments. And diversification obviously becomes very, very important. While one may do diligence, and I mentioned some of the things that need to be kept in mind while taking investment decisions. But obviously, there's a possibility that something may go wrong. So it should not happen that, you're putting a significant portion of your wealth at risk by investing in only one paper. So, that definitely becomes very, very important. Ideally, not more than 5% of your money should be parked in any single credit. I think that's something to go by.
Okay, we've talked the whole session about the high yield debt products, but can you give us some range of what kind of returns an investors can get from these products? Mr. Anshul from the I think most of the products that your platform is issuing is secured bonds, right? Senior secured bonds. So what are the kind of products that?
Right. So we only offer senior secured bonds on our platform, and we target a delta of 300 to 500 basis point over risk-free products like FDs, etc. So in today's market, that will translate to a yield bracket of 9 to 11%.
Okay, Mr. Vibhor.
Yeah, so I think we have a lot more depth on our platform in terms of the variety of products on offer. So we would, offer papers which are yielding sub 6%, right? Where the rating could be as high as AA plus AAA, and then going up to mid-teens as well, right? For some of the papers, which are for BBB rated entities. So what we see is that beyond retail investors, we also have a lot of sophisticated investors who are there on a platform who can take that credit view on some of these high yield instruments. And, we believe that there is a market for each of these products as long as we are picking these products right and pricing it right. The investor is taking an informed view. So we're pretty much there across the entire yield spectrum in that sense.
Fine. All right, ladies and gentlemen, now we come to question and answer session. Maybe we'll wait a moment as we gather some questions. Please don't forget to mention your name, listeners, when you're asking some questions. Okay, we have our first question. This is from Ms. Veera Shiva. Question is, issuances in 90s and early 2000 did not end well for investors. Why would this time be different? Mr. Anshul?
Sure. No, so, I mean, these are not like risk-free products. So there are mitigants which we build in while manufacturing these products on our platform. We don't mix tenor with credit, which means most of the issuances that we bring on the platform, the tenor is in the range of 15 months to, let's say, 3 years. Some of the checks that we apply on the platform are onboarding issuers where the leverage is low, so that margin of safety for debt investors is on the higher side. Most of the entities are backed by private equity firms, so that deep pockets are available in case of any stress. They have a diversified lender base. Almost all the entities that we onboard have had at least 10 lenders on their liability profile. So there is no dependence on any single lender for their future growth, etc. But in spite of all the mitigants, I mean, these are not risk-free products. So yeah.
Sure. You want to add a line, Mr. Vibhor?
So, like I said, the products need to be priced well. And there is a market, for all products, right? For example, over the last 4 years, across all the platforms, not necessarily the bond platform, we have disbursed or enabled a fundraise of almost $10 billion US, right? Now, what we've seen is almost 50% of this amount has amortized, and the cumulative losses that we've seen on all transactions that have happened through our platform is less than 1 basis point. So yes, these are not risk-free investments. Anything other than GSEC, Anshul mentioned that we've seen very high rated entities also defaulting and investors taking a significant haircut. So, there is a chance that, something may go wrong and the investors may lose money. But as long as they follow the basic principles of investing, which we kind of touched upon during the course of the discussion, I think investors should be fine over a long period of time.
Sure. The second question is from Mr. Yogesh. Why should investors choose high yield bonds over perpetual bonds issued by high rated banks as the later is more safer and they are callable after 5 or 10 years? Anybody?
So I think the investors in Yes Bank 81 bonds would probably disagree with this view. So, definitely the risk in a pub bond is much higher than a senior secured bond. There are loss absorption features which are there in these instruments. And if certain thresholds are breached, there is a possibility that these instruments may be written off or the coupon payments may not happen. So, I would not agree that perpetual bonds are very, very safe. Yes, I mean, if the bank is rated at a very high level, and we are talking about a senior debt of a low-rated entity, you can argue that the pub is safer, but it need not always be the case. As a structure, a senior secured bond would always get paid at a priority, or a deposit holder will always get paid at a priority in the event of liquidation, or if something goes bad vis-a-vis subordinated debt or PERP.
Sure. The next question is from Shefali. Mutual funds mostly invest in AAA rated bonds. How can we get them to invest in lesser rated bonds to give investors more options? So this is an interesting question. So yeah,
I can see Mr. Dijala smiling on the panel. So, so I think most of the mutual fund regulations in India, they have become like very stringent of late. Maybe an offshoot of the Franklin crisis that we had. One other thing is, I think if mutual funds have to come in the credit market, it needs to be via closed-ended structures, something like a FMP. Because we saw during the Franklin crisis that the fund was investing in credit papers, which were illiquid, but the structure as such was an open-ended structure. So it was more of a structural issue which was there. So hopefully in future, we will see mutual funds coming up with closed-ended credit-focused FMPs. And maybe by engaging with the regulators, etc., the regulations will also allow them to invest in such papers.
I think maybe then the credibility of these products might increase if that happens. Right. So there's another question. Mantly of the structured transactions by majors like KKR went under. So what edge does a retail investor have in this segment? Mr. Vibhor?
Sorry, I did not catch the question. Can you please repeat?
Yeah, it's slightly not clear, but it says that the structured transactions by majors like KKR went under. So what edge does a retail investor have in this segment? So it's just probably asking about the safety of these products for retail investors, for common people here.
No, so see, obviously, retail investors are at a disadvantage when it comes to taking a call on complex products which have nuanced structures, right? They would not, like I said, one big issue is information asymmetry. They would not have access to all the information to take a proper credit decision, something which an institutional investor can do, right? So I think, therefore, it becomes more and more imperative for them to have credibility in some of the counterparties which are doing that job for them. So the rating agency, and if they rate the structures right, that becomes an important consideration. I mean, if they would obviously look for advice from their investment managers who could help them navigate through some of these structures. But otherwise, if they don't understand complex transactions or structured papers to that extent, I think my view would be then they should kind of stay away from such investments.
Sure. Maybe we'll take the last question, which is how large is the market of high yield that may be suitable for retail investors? Mr. Anshul?
Sure. So I think we did this exercise some time back. So if you look at most of the issues in the market, in the bond side, they primarily come from NBFC sector. If we remove the top 5 NBFCs in the country, because there the yield segment will be around 5.5 to maybe 6.57%. In the 7% plus segment, the total AUM of NBFCs will be close to around 15 lakh crores, assuming they have a 3-year liability. So on an annual basis, they'll be issuing liabilities worth around 5 to 7 lakh crores year on year. Maybe we can add another a similar amount from the non-FI sector also. So that's the ballpark figure that we are looking at, roughly around maybe 15 lakh crores to 25 lakh crores worth of liabilities, giving
That's
returns which are more than 7%.
That's huge. Sure. Maybe we'll take one more question. This is from Mr. Mohit Pradhan. How evolved is the Indian fixed income derivatives market? Interesting. Mr. Vibhor, maybe you want to take this question?
Synthetic products is not, or derivative products is not something which is kind of being looked at by a large set of investors, right? So, for example, Indian securitization guidelines themselves, do not allow synthetic securitization transactions or complex derivative transactions, which are where the underlying is not the hard assets but a derivative of that. So that's something that is not there in the market today, and probably rightly so, because I think we've not the Indian market has not evolved to that stage. Like we've been discussing that there's very little liquidity which is there in papers even below AA category. So till the time the markets involve and we have a large set of investors who can look at at different with different risk appetite and complicated complex products. I think this market is going to remain small, and it's still some distance away.
Sure. Again, we got another question on taxation aspect. So is there any indexation benefit or the platform has a disadvantage? Is there any indexation benefit on this product?
So see, the platform is just an enabler, right, for giving them access to these fixed income instruments. The taxation obviously is governed by whatever the CBDT has laid out in terms of what taxation will apply on each of the fixed income product that an investor is investing. So there's no benefit in terms of taxation that comes in by virtue of investing through a platform as opposed to directly investing, for example.
Sure. Maybe we got one more last question. This is from Maulik Tiwari. There are many bond platforms that hold an inventory of bonds. Would pre-selling bonds before maturity on such platforms be easier than, say, selling to a broker who doesn't have an inventory of bonds? Shall I repeat the question? Or Mr. Anshul, do you want to take this?
No, definitely. I think of late, a lot of bond platforms have come in the market, and obviously, like more the participants in the market, more will be the liquidity. At least at Wint Wealth, we don't list secondary bonds from the market. We manufacture our own bonds and list only those instruments on the platform. But there are platforms in the market which are facilitating secondary transactions also, and depending on the investor depth on those platforms, to that extent, liquidity definitely is being generated.
So see, our platform enables sellers to list instruments on the platform and get liquidity, right? So we enable secondary market transactions even on papers that we are not manufacturing, right? Now you spoke about a seller going to a broker and vis-a-vis putting out a paper on our platform. Now, if it's a broker, however large a broker is, and whatever is the fleet street or the battery of sales force that it has, there is always a limit to how many investors that you can approach physically and through an offline route, right? Whereas a platform like ours, enables a large set of investors to, on a real-time basis, see the moment this instrument is listed online. That investor could be based out of tier 2, tier 3 cities as well. It's highly unlikely that, he would be otherwise having access to this bond instrument through the offline route. So that way, I would say that the sheer outreach that a platform would provide because of the distribution capability by leveraging on technology is far higher than a standalone broker. And it should definitely be easier to liquidate it through the platform.
Sure. All right, ladies and gentlemen, now we've come to the close of the session. Thank you, participants, for joining us. We hope the session is insightful and you have some good takeaways to make an informed decision on your investments. We've talked about where high yield debt products stand as of now in India, and some questions also from investors' point of view. Also, we had interesting questions and interesting answers. Thank you all. Thank you for joining us. And thank you very much, Mr. Anshul and Mr. Vibhor, for addressing this interesting topic. On behalf of CFA Society India, I would like to thank you again for joining us today. Thank you.
Thank you.
Thank you.
Over to Mr. Vijayanath.
Thank you, Satya. Thank you, Anshul, Vibhor, and Nikhil. So my personal takeaway from the session is, I don't want to be on a panel if Satya is moderating it. She is phenomenal.